Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest and good friend of mine, somebody I highly respect, amazing entrepreneur, Dan Handford. Thanks for being on the show, Dan.
Thanks for having me back, Whitney. Really appreciate it, and looking forward to sharing some more with your audience here.
Yeah, Dan's been on the show numerous times in the past and has been gracious in sharing his expertise. And I'd encourage you. He was on show number 14. It's incredible. We were just reminiscing about way back then and everything that's happened since then in both of our businesses and friendship. And we've done a series of shows between 225 to 246. I would also encourage you to go back and listen to. But a little more about him before we dive in. He has extensive successful background in starting multiple seven-figure businesses from scratch, including a large group of non-surgical orthopedic medical clinics located in South Carolina. He's the founder of the Multifamily Investor Nation, where he educates a nationwide group of more than 9,000 members of multifamily investors on how to properly invest in multifamily assets. He also is the co-host alongside his wife, Danae, of the Tough Decisions for Entrepreneurs podcast. Dan, thank you again. And also the Multifamily Investor Nation podcast as well, right?
That's correct. That's correct. And I should have updated those numbers with you because we're now up to 26,000 members in the Multifamily Investor Nation. So
26,000. Yeah. So, wow. Congratulations, Dan, on that. Just amazing success and what all you've accomplished. And why don't you give us a little update on where the passive investing team is right now? I know a lot's happened since you were on the show last. I know we've been keeping up with you and we've just talked and been at different conferences together at the same time, but update our listeners a little bit and let's jump into a few red flags we're going to try to get to for passive investors when investing in multifamily syndications, but update us a little bit first.
Yeah, so I'm one of the managing partners with a group called passiveinvesting.com, and we acquire multifamily assets primarily in the Carolinas. And we have, over the last 12 months, acquired just over 100 million, 120 million in acquisitions and raised just over 35 million in equity to be able to acquire those assets. And we're continuing to do that. So obviously we're going to talk about a few things today, probably as it relates to passive investors and red flags, because not only am I an active investor, but I'm also a passive investor as well. I'm currently in 21 different active passive deals as a multifamily passive investor. And so and that's with 8 different operators. So it's not just with one operator or myself, it's with multiple operators. And so I have some criteria that I look for when I'm looking to invest in somebody else's opportunities. And so I thought it would be helpful to share with your audience those red flags that I look for that will cause me to maybe, pause a little bit before I actually invest.
Yeah. So, I love that you're on the active side as well and very involved in doing deals. And so I just think that gives you another level of experience, from understanding what passive investors are looking for as well. I know there's a list of things that we could go through that are potential red flags, and we cover a lot of them at different times with different people on the show. But things have changed recently in the market. Right. As everybody that's listening and Dan's been affected by it, no doubt. And so I'd love for us to jump into just the current market and red flags for investors right now, what they're looking at and maybe some things you're considering from the active side that also affect, on the passive side, people who are looking to say, okay, I know I still want to own real estate. Maybe this is the time to get in. Maybe it's not, I'm not really sure with everything that's happening right now. We'd love your input, Dan.
Yeah, so right now, this is the beginning of April. So this is today is I believe April 6th. So in our apartments that we own, rents are due April 1st, and by April 5th they're late. So today is going to be the first true sign as to how these properties are performing, and so we'll actually hopefully be able to know that a little bit more in the next couple of days here. But right now, as far as the acquisition side and whether or not you should actually be acquiring right now, there's a couple of things from a passive side that you'd want to make sure of. So a big red flag for me would be if an operator underwrote a deal before all this happened in, say, January, February, or even the beginning of March, and they didn't change their underwriting since they've been into the deal, right? because that would be a big red flag. Now, a yellow flag would be they're still trying to acquire the asset, right? So, and the yellow flags aren't necessarily like completely don't do the deal. They're more of like a, let's sit back, let's see how they've actually underwrote this deal, how they actually underwrote it to mitigate the potential risks that are coming right now with the economic, slowdown and because of COVID-19 and things like that. And so one of the things that I would definitely say that you have to look at right now is what's the business plan like right now, given the COVID-19? If they originally underwrote that it was going to take them, say, 15, 18 months to, lease up a deal after they did renovations, hopefully they have actually changed that plan to mitigate that, because over the next probably 3 to 4 to possibly 6 months or longer, it's going to be a little bit of a slowdown. You're going to have a harder time with that rent growth. And so that renovation plan is going to take a little bit longer. So if somebody originally did 15 to 18 months, you're going to want to see at least probably 24 months or longer in being able to execute that business plan. And so obviously making sure that that's in place is a crucial piece. And that's really for the B and C class, right? When you're looking at more like a higher end A-class property, obviously you're not going to do renovations, but you still, on that A-class product, you want to make sure that the rent growth assumptions, especially for that first 12 months, is not overly stated. So you want to make sure that, I would probably say at least 1% or less in rent growth over the next 12 months, if that at all, right? Because right now with what's happening, you can already see it in some of the CoStar analytic data that the rent growth has actually started to slow down already during the month of March. It's actually started to go down. And so you have to and a lot of that has to do with these daily repricing software models that reprice the software every single day based on the current market conditions, that allows us to kind of have a pulse on what's the inventory like, what are the actual turnovers like, and what kind of vacancies are actually being seen across the board, because that's what causes those prices to actually differ on a daily basis when you're using one of those types of models. And so that's one piece is making sure that you're looking at the renovations as well as the actual the length of time when it comes to these renovations. And if somebody is in a C-class product right now or a B-class product right now, and they're trying to raise for it, it's going to be very challenging to kind of figure this out, because that's the lower end Bs and the lower C-class assets are the ones that are getting hurt right now the worst, because those are the people who have those jobs that are being lost, those furloughs, the unemployment. And hopefully all the stimulus that's happening with the economic stimulus and the increase in the unemployment benefits and things like that, it will help mitigate some of that damage. But at the same time, those are the people that are getting hurt the worst. When you look at more of an A-class asset, you have more of your white-collar professional that's not usually living paycheck to paycheck. They usually have extra I said operating reserves. I'm thinking of our properties, but they usually have extra in savings or extra reserves to be able to pull from if they do have a little bit of a slowdown or a dip for, say, a 2 or 3 month period of time. So those are just a couple of things, Whitney, that I would definitely caution somebody when they're moving into a deal right now amidst all this COVID-19 stuff.
So it doesn't mean they should just back out completely, but they should see some changes, and hopefully that operator's communicating these same changes with them, right?
Absolutely. That's the biggest thing right now with this type of situation, is being overly communicative. And even with our own assets this month in April, we actually started we started weekly communications with our investors, because we want our investors to understand what's happening with their asset that they've invested in. So normally we do a monthly update that's sent out by the 14th of the month that talks about the prior month. Well, right now, every Monday, we're sending out a report and a monthly update report, so a weekly update report, so those investors can understand how the asset's performing. Because today, like I said, is April 6th, right? This is when all the rents are late. And so by now, we should know at least how many of our residents have actually made their payments and how many of them have asked for payment arrangements and things like that, because most cities right now have ordinances that are, eviction moratoriums that would prevent you from being able to evict somebody. And right now, given the situation, I really don't want to have to evict anybody, right? So we're trying to do our best to be able to, maintain occupancy and making sure that we can increase the ability for our properties to do payment arrangements so we can keep those residents in the properties as long as possible. But you have to make sure that you're communicating with investors on a regular basis. And right now, I feel like weekly is a really important thing to do, because I even right now, every day I'm getting in emails and phone calls and text messages from our investors. Hey, how's this property doing? How's that property doing? And so instead of having to respond to all those separately, we're going to start sending out that weekly update here in the month of April.
So Dan, as a passive investor, you've got a lot of experience on that side as well. If we're not currently investing in a deal right now, we haven't committed to an operator right now, should we just be sitting back on the sideline for a few months to see what happens, or should we really be looking to invest right now if there's opportunities? What's your feel on that?
Well, I think it depends on your current situation, because if you're an accredited investor, which means you have at least $1 million of net worth, or you have at least 200,000 if you're single, 300,000 of income if you're married for the last 2 years, and you expect it to continue, then you have a little bit more cash to play with usually, right? And so usually if you have a little bit of excess there, you have the ability to invest even in times like this, right? I personally am still investing in this type of a market. There's actually a deal that I was in just recently that actually fell through. So I had already wired the funds and sent it in, and it actually fell through, and I got the funds back. But again, that operator was constantly monitoring the situation, and they realized that this deal just wasn't going to be a deal that really was going to make sense given the whole situation. And so they appropriately backed out. I wasn't upset with them. I was still wanting to invest with them, but I also trust the operators that I'm investing with to make sure that they're making the right decisions. And our investors here at PassiveInvesting.com trust us in the same way, right? We've had deals before that we've had to back out of, and they understand that, right? And it's not been a lot of them, right? But there's been situations where we've been like, okay, no, this deal now does not make sense. So instead of trying to get into a deal that doesn't make sense, then we would rather just pass on it and go find that next deal.
And that leads right into another great point as far as just vetting operators. And I've talked about on the show recently about, this is a great time to vet operators. And we talked about it a little bit on the underwriting, and just as you're vetting new operators, asking, well, what has this done to your operating models or your underwriting models, and how has this changed your business plan, and learning how an operator operates through a tough time like this. What are your properties doing? But I'd love your take on that as well. And you just mentioned too, trusting the operator, and I say even in bad times, you've already built that level of trust. And so, the operator's performing at a very high level, that they're doing the best that they possibly can to safeguard those investments of all their investors. But I'd love your opinion too, just about vetting operators and during this type of crisis as well.
Sure. So there's three. I originally told you two, Whitney, but there's actually three things that I think are really important, especially right now given the COVID-19. The number one on my plate that I look for is I want to see somebody on the operations team that has some form of background and success in business, right? And the reason why that's important is because when we're buying these larger assets, which is what we're doing, we're buying businesses that just so happen to have an asset associated with it. So I want to have somebody on that operations team that knows how to, put in systems and procedures and processes in place, that knows how to manage people, knows how to make decisions in times just like this, because these are the times that decisions have to be made. You can't sit back and just wait to make decisions when this kind of situation is happening. You have to be decisive, and having somebody who has some sort of successful background in business, I think, is a very crucial piece. The second piece that I look for is an operator that's full-time in the business. I want somebody who is full-time. They've invested everything full-time. And that to me is very important, because I've worked very hard to earn the money that I've got. And I know our investors have as well. And so all of our managing partners are full-time in the business. And I want to invest in other operators that are also full-time in the business. And then the third thing that I look for is more of a structure in the operations team. So I won't invest with somebody if they only have one person as the operator, because I have heard of stories before, and I probably know you probably have too, Whitney, where somebody has invested with an operator that only had one person as the main operator, and then all of a sudden that person went ghost on them and they can't find them. And then, of course, I know of somebody right now that's in New York City that's a friend of mine, and he invested $200,000 in a deal, and his friend invested $200,000 in a deal, and the operator went ghost on him, and they can't find him. And, of course, you go back to the operating agreement, and what does it say? In order to get out, you got to have arbitration. Well, how can you arbitrate with somebody that you can't find? And so they're just kind of stuck in this kind of middle space right here where their equity's caught up. The property's still there. They're still generating revenue, but they're not making distributions because there's nobody to make distributions. And so for me, I have to make sure that there's at least 2, but I do like to see at least 3 to 5 people on that operations team. Probably not closer to 5. My preference is 2 to 3 really when it comes to an operations team, because when you start to get 4 and 5, there's a little bit too many cooks in the kitchen. Just depends on what kind of role they play. So if there's more of a minority role with those different operators, then it might be still a little bit more palatable for me. But I want to make sure that there is at least more than one person that's in that main operator position, because I don't want someone to go ghost. And I will also tell you this, that we all talk about masterminds, right? And masterminds are when you get two or more minds together and you start to strategize, try to think about how to improve, right? Well, how can you do that when you only have one person as the main operator? You want to be, and I've seen it right now today that there's an operator right now that I know who's the only operator, and that operator has no one to bounce ideas off of, and so they're like basically bouncing ideas off of other random people that aren't even part of the property. And so right now you have to make sure that you're investing with somebody who has multiple people, because for us, we have three managing partners. And so every single day we're on phone calls and we're masterminding, we're strategizing, and we're making sure that we're getting things done properly for our investors. And for me, I want to make sure that I have multiple operators.
Love that. And I haven't heard many people say that, if anybody, before on the show, as far as vetting operators, thinking about the structure of that team and having more than one person on the operations side. And because I know personally, you and I both have experienced just like a leap in growth once we've joined a good partnership, whether that's with one person or a whole team. It's a game changer, personally. And I think for passive investors as well, I think it's a neat way to think about that. So, a few more things I know we want to cover before we run out of time, Dan. But let's talk about the preferred return structure a little bit, and some other return structures that maybe an investor needs to think about, even specifically right now, in the type of the crisis that's happening. I know there's different ways that we've heard different operators think about this and talk about this, but I love your opinion from the passive investing side as well.
Sure. So we can talk about the preferred returns in 2 different areas. So let's first talk about the traditional preferred return model, right? So we have the preferred return, which, for those listeners who are unfamiliar with that just a little bit, the preferred return is basically the operator out of the cash flows giving you 100% of the proceeds until you would meet that preferred return. And then there's usually an equity split after that, right? Or a cash flow split, usually around 70-30, okay? 70% to the investors, 30% to the operations team. Well, the preferred return, in my opinion, is something that I always look for. And I feel like it's a red flag when the operator does not provide preferred returns. And the way I look at it is if the deal is so tight that you can't provide preferred returns, or that the operator needs the equity splits earlier, and that's why they're not giving the preferred returns, that operator is not well capitalized enough for me. I want to make sure that those operators are well capitalized and they don't need those preferred, those splits, if you will, earlier on to have no preferred returns to be able to live off of. And so
okay.
I want to
when
make
you
sure
say well capitalized, I was going to ask you if you meant personally or like within that property or business specifically.
I would specifically say within that property itself. Now, obviously, from the lender's perspective, they're going to make sure that that there's somebody on that team, that loan guarantor, if you will, is right, well capitalized as a backup or a fail safe, but the actual deal itself too, right? But the operator at the same time, in this situation, if they don't provide preferred returns, what I see a lot is that the reason why they don't is because they need the money to live off of, right? They need that 70-30 split earlier on. And what I mean by earlier on is if there's no preferred returns, every dollar that comes in off the cash flows as profit can be split 70-30 instead of actually waiting until the investor gets their preferred return first. And so for me, I want to make sure I'm protecting my investors first, because I'm not planning on just putting one deal together. And I know you're the same way, Whitney. Like, we're not planning on just putting one deal together. We want to have this thing as a lifetime, legacy to be able to build alongside of our investors. And so this is not just a one and done type of situation with us. We want to make sure that we're growing with our investors. And those preferred returns are very crucial, because I feel like it's the best way to align interest with the investors, because we couldn't put these deals together if it weren't for our investors. And at the end of the day, we have this 70-30 split, and our team talks about this all the time. We have this 70-30 split, but at the end of the day, when we go and sell an asset, if we have to give up a portion of our 30% to make sure our investors achieve the returns, then we're going to do it, right? We want to make sure
no
that we
doubt
do
about
that.
it.
To me, it's not about just making my 30%. I want to be rewarded with my 30% if I can outperform that asset. And so that's one thing that we do with our group is, hey, we have that 30%. If we have to give up, 5, 10, 15, 20% of it to make our investors whole at the end of the day, we're going to do it, right? And that's something that a lot of people don't talk about. I've never heard anybody talk about that, Whitney. But it's something that our group talks about all the time. And I'm going to shift here to a little bit different piece of preferred returns. And it's still preferred returns, but it's also preferred equity at the same time. So there's, lately, or probably over the last kind of year and a half, we've started to see this dual class structure where you have Class A as a preferred equity piece. Then you have the Class B, which is your traditional, 7 or 8% preferred return with a 70-30 split after that. Well, the preferred equity piece is usually 25 to 35% of the equity stack, and it provides you no participation in the upside, but usually a higher, like a 9 or 10% preferred return that you get along the entire hold process. And so for somebody who's listening right now, who's maybe in this situation going, I really don't want to invest right now because I'm afraid I might, not achieve the returns that I'm looking for, or maybe we won't receive the cash flows, or maybe I might lose some of my investment. I think that the Class A would be a perfect choice for you, because the way that works for the sophisticated investors, and especially a lot of these institutional investors, they actually prefer to be in that preferred equity position because it's not a guarantee, but it's pretty close to a guarantee, right? Because the Class A investor, that preferred equity stack investor, that Class A has to be paid first before the Class B investor sees anything. And so if you're kind of on the fence there, a little bit uncertain as to where you want to be, go into a Class A position if you need to, because you're pretty much guaranteed that. Because even if, let's just say you have a 9% preferred return in that Class A position, well, it's only 25% of the equity stack. So whenever those distributions are happening, you're going to get paid all of your portion first before Class B gets anything. And if for some reason you go down to say 7 or 8% during that hold period, because maybe the market shifts or whatever, or the business plan doesn't go exactly as planned, when they sell that asset, there should still be plenty of extra there to be able to pay you. Otherwise, there's nothing for Class B and there's nothing for Class C, which is the operator. So being in that Class A position right now, for somebody who's a little bit uncertain and wants more of just that I don't want to say guarantee, but that surety to some of that cash flow and that overall return, I think is a great position for a lot of people.
Which of those are you investing in right now, or are you still investing with operators that are not doing that type of structure?
I'm investing in both. So I'll invest with an operator who doesn't do that structure. But what I actually prefer, Whitney, is a blended option where I can put 50% of my investment in Class A, 50% of my investment in Class B, and you have this nice blended return, which increases your cash yields over time during the hold period. But then it also allows you to still have participation in the upside. But it's a nice blending of the risk profile within the same investment.
Nice. So how have you seen, or would you expect the preferred return to change right now through this type of crisis and what we're seeing right now?
Well, I mean, for deals that are being put together, I would hope that nothing is being changed as far as the preferred returns, because even if the cash flow is going to be a little bit light, I would still want to see that preferred return of 7 or 8%. And even if they never achieve that during the hold period, I still want to be made whole when we go in and sell that asset to that 7 or 8% preferred. And so to me, I would say that the preferred return should stay very consistent with where they are right now, staying in that 7 or 8%, because we've put together deals right now where, that preferred return is a little bit up. The preferred return, the cash yields year over year is less than that preferred return. And the investors are just told that up front that, hey, the first year is going to be a little bit light on cash because of the given situation, but the next few years after that, it's going to be doing really well. And we'll make that up in future proceeds whenever we have that coming in. But the nice thing is that if you have this dual tranche structure and if the Class B investor gets anything, the Class A is going to get their preferred return, which is usually higher around that 9 or 10% mark.
How soon should you, as let's say we're, the passive investors investing in a deal right now, how soon should we see a distribution, giving the current state of the market?
Well, I mean, that's a great question, because there's a lot of unknowns and uncertainty right now with
Right.
where are the cash flows going to be. But there is also a lot of things that you can do from an economic stimulus standpoint. And so there's deals right now that, I mean, so far all of our deals have not stopped distributions. Now, this is the month of April, so this is kind of like the true time as to what's going to happen, and we're going to have to make decisions this month as to which properties we might or might not need to do that with. But we also want to make sure that when we're acquiring assets right now, we set realistic expectations for those cash flows. And that's going to be determined once we actually get into the deal, right? But I would say for me, what I like to see is monthly distributions. So I don't invest unless we have monthly distributions. And so I want to make sure we see that. And one of the main reasons why I like to see monthly distributions is because I've seen operators who do quarterly, and they don't get those stats until the beginning of the next quarter. And now they're doing a retrospective analysis on the prior quarter, and it's too late to make any changes or pivots. But I want them making monthly decisions on how that asset is performing. And so it's a way for me to know that they're actually looking at those finances on a monthly basis. So if a deal right now is closing, say this month in April, you're going to probably have another 2 or 3 months worth of no distributions until you start that back up, depending on how that property performs. But if you have a deal that's closing a little bit later, say maybe May, June, July, things might be a little bit different. So I think it just depends on how that property is performing right now. But to set your expectations up front, I would say probably, waiting until probably, August, September, October, somewhere around in there to actually start seeing those first distributions, just to set your expectations realistically. And hopefully the operator you're dealing with is one that will make up those distributions as the cash flows start to come in. Because right now there are a lot of things that are happening, even with these properties that, we're considered a small business, each property is. And so we're able to get our payroll 2.5 times, right now, paid for with the economic stimulus. We're able to get some grant money right now that's available. And so there's a lot of different things that are happening from the property side, but even from the resident side, they're all able to also get extra unemployment benefits, and they're also getting their payroll even if they're not working and things like that. So there's a lot of things that are happening from the government side of things. And on the other end of this, I know we're going to go out strong, and long term multifamily is going to continue to have a lot of demand. There's 3 things that always happen, Whitney, and when there's some sort of a downturn or really a pandemic, right? First off is there's a lot of divorces. There's a lot of marriages. And of course, the third thing is there's a lot of births. And so those 3 things long-term create a lot of demand for multifamily, which is great for us in the long term.
So that passive investor that's in a deal right now, and the operators reached out and had to say, we're going to delay distributions, for the next few months, and we don't know how long, should they be worried? Should they not? What's your opinion, thoughts about that?
Well, first off, I wouldn't just automatically suspend distributions indefinitely, right? Until for the foreseeable future, right? I would say, all right, this month we're going to go ahead and withhold distributions because we want to make sure we have enough in operations if we need it. We don't want to have to dip into our operating reserves if we don't need to. So you withhold for that 1 month, and we'll reassess and ask that question the next month. And so every month they're making that decision, can they make distributions? But again, this goes back to why I like monthly distributions, right? Because if they're doing quarterly distributions, then it's going to be 6 months down the road before they make the next decision on, whether they can actually make those distributions, or I guess 3 or 4 months down the road, right? So now there's been 6 months of a gap of distributions where, for me, I want to see monthly decisions being made on the assets. And so I don't necessarily think that you should be worried. I think you should actually be proud of your operator that has to withhold distributions, because they didn't expect this. Nobody expected this. It's not their fault that this happened, but they're making the right decisions and the best decision as a fiduciary to your investments in that particular asset.
They're being
and
proactive.
You have to make sure that you are happy with that, because you're the one that wired the money to them and trusted them. So you also have to trust them during this time, and don't be upset. Be proud of them, because you would rather not take a distribution than have to be doing a capital call and diluting your shares if you had to.
We are about out of time, Dan, but yeah, that it does lead me into one more question, though. Just wanted to cover, and that goes into that reserve budget. Just how do we know if the operator has a large enough reserve? And I would say right before all this happened, we closed on a large project, and some other operators were saying, Whitney, that's too large of a reserve budget. That cuts into those returns too much. That's just too big. I'm like, wait a minute, I just feel better about having a large reserve budget, probably much larger than what most other operators tend to have.
So let me ask you this, Whitney, how much do you have in reserves?
$1.5 million.
So we have 1.7 in one of ours right now. We have 1.4 in another one, 1.2 in another. And I don't think that that's a crazy number, right? I think it's a smart number, honestly, because it allows you to have those extra funds in case you need it. Now, I hope we never have to dip into that. And yes,
Right.
it is expensive, but for you and I, it allows us to be able to sleep well at night,
That's
because
for
we know
sure.
we're not going to ever have to, I won't say ever, but it would be a very rare situation where we actually have to dip into those operating reserves to a point where we had to do a capital call in the future. And so I think it's a smart decision for you to actually do that. I think I wouldn't fault you for that at all. That's why I asked you about what it was, because I figured you and I were probably very similar as far as making sure we had plenty of operating reserves. And at the same time, when that operating reserve is going to go back to the investors if for some reason, when we actually sell the asset and we put those proceeds back in, right? But one of the things that I'll also mention about the reserves, because you asked me, what is a right number to kind of, keep in operating reserves? To me, I want to see if the property goes to 0% occupancy, right? Which is extremely rare. But if the property goes to 0% occupancy, I want to be able to meet the expenses and the debt service for about 3 to 6 months, right? But with us, obviously we have ample operating reserves, and it's very rare is it going to go down that low. But let's say it drops down to 50%. Well, now I have 6 to 12 months worth of operating reserves in place versus just, 3 to 6 months. And so I think it's a smart thing right now, especially right now, to make sure you have ample and operating reserves. And there's never a situation where I would say it's too much, right? I mean, obviously, trying to, put way too much, but then the returns are going to go down and just going to kill the deal anyway, right? But I think that you're right. You have to have enough in operating reserves right now. That way, if you, for some reason, you do have to dip into that, you're not having to do a capital call with your investors, because that looks a whole lot worse.
All right, Dan, just a little shift, just a few final questions before we have to go. What's a way you've recently improved your business that we could apply to ours?
We recently, with our business, we actually just hired two key people. One of them was back in the fall of 2019. One was in the first quarter of 2020, was a director of marketing and PR. And she's been absolutely phenomenal for us, and has taken us to the next level when it comes to, our presentation, our communications with investors. And then we also hired a full-time asset manager who actually worked for one of the largest REITs in the country and has managed multiple billions of dollars worth of assets, over 100,000 units, and has been helping us put in additional systems and procedures and processes in place, and has been very crucial for us right now with our acquisitions because of this whole COVID-19, but also managing the assets that we have right now, because he's been doing this thing for over 20 years. And so he's been through the dot-com bubble issues and the 9/11 and 2008. And so he's been through all these different situations that are different than what we're seeing right now. But they have similar responses to what we're seeing right now as well.
I love that answer, because it also goes back to that business structure question that we were talking about earlier. And you're adding team members that are extremely experienced and just improving just every aspect of the team. I mean, it's incredible. So tell me a way that, or tell me the one thing that's contributed to your success, Dan. What do you say that is?
So one thing that has contributed to my success, I mean, I would say that one of the things that has contributed to my success is that I'm the type of person that likes to measure things all the time. I like KPIs. I like statistics. And a good mentor of mine years ago told me, he said, if you can't measure it, you can't manage it. And for me, everything that I do, we try to measure so that if we need to manage it, we can. And even to the point of even in my medical clinics that I own, we sit down once a month for a corporate meeting, once a month for an hour, and my team goes over all these different metrics. And you'd be surprised at some months where we look at metrics, and we're like, we didn't even know if that was going to be a metric we really needed to see. But then we start to see that metric move or change, and we can pivot and make some changes. So for us, and for me personally, being able to measure things has really helped us be able to manage things to a point where we can create a lot of success with it.
How do you like to give back?
Well, I'll tell you right now, Whitney, that in the fall of last year, I started a new nonprofit organization. It's called the Fortify Foundation, and it's a foundation that helps private Christian schools be able to create their own foundation, because a lot of these Christian schools don't have that in their thought process, or they don't have the staff to be able to put together a foundation that will allow them to be able to fortify, if you will, and kind of build up their actual their kind of nest egg, if you will, to allow that nonprofit themselves to be able to go forward. So what we're doing is we're coming alongside these small to mid-sized Christian private schools, and helping them create their own foundation, so that instead of going off and, they're one of the biggest flaws that I see in Christian education is that, they go off and they say, oh, we need new computers for the computer lab, and they raise 10 grand for that, but then the 10 grand spent and it's gone, right? Well, so I used the same concepts in multifamily and said, what if I could create a foundation that can invest in assets like multifamily, right? And have a diversified portfolio across multiple assets in many different markets, and allow them to be able to still spend money off the returns that they're making off of it, but then the main principle never goes away. And so we've actually started to develop this. It's still in the infancy stages, so we're still kind of in the developing this. We just hired our first interim executive director to kind of help us get it off the ground. But that's one thing that I'm doing right now, and I'm pouring a lot of money into that to get it started, because our kids right now go to a Christian private school, and I see a lot of Christian private schools that are going under right now because they're just undercapitalized. And if they can find a way to create a foundation that'll allow them to be well capitalized and into the future, then it'll be a legacy for everybody that we can actually create for them.
Love that. Appreciate you sharing that, Dan. Amazing show, very timely, just with the information that we've covered today. No doubt about it. I know the listeners have enjoyed this and probably learned a lot. But tell them how they can get in touch with you and learn more about you.
Sure. So I'll give you two different ways you can find me. So first off, if you're interested in investing with us or thinking about, wanting to, learn a little bit more about us, you can go to passiveinvesting.com. Pretty simple there. And on the top right-hand corner of the screen, there's a button that says join the Passive Investor Club. And if you fill that form out, I'll jump on a phone call with you, do a one-on-one call with you, discuss your investment goals and see if you're the right fit for our group. And then the second way, if you're just interested in learning more about multifamily and educating yourself, you can find out more information by going to the multifamilyinvestornation.com site. And you can also go to the mfinpodcast.com to find us on our podcast. And of course, we're all over the place, as you know, Whitney, on YouTube and Facebook and LinkedIn and things like that. So thank you so much, Whitney, for having me on, and looking forward to being on in the future.
My pleasure, Dan. And why don't you tell them, do you know when the next summit's coming up?
Yes, it's going to be June 11th, 12th, and 13th. So thank you for that, Whitney. I forgot about that. It's called the Multifamily Investor Nation Summit. It's an all online virtual summit. And yes, because of COVID-19, a lot of people are doing a lot of virtual events, but this is something I've been doing, as you know, Whitney. This is my fourth time doing it, right? This is our second year doing this, and really excited to have it and doing it again. And I appreciate you helping us be able to promote it. But if you're interested in joining us there, you can go to mfinsummit.com. And I tell you what, Whitney, I know I did this last time when I was on the show with you. I'll do the same thing where I'll have a promo code set up, which is just going to be Whitney, WHITNEY, Whitney. And that'll give your listeners the ability to register for $100 off, but then all the proceeds I'll give to your nonprofit.
Awesome. Thank you so much, Dan. Appreciate your partnership and friendship as well.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.